Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Economic data continues to come in just days ahead of Election Day. Today, no exception, the Fed's preferred measure of underlying U.S. inflation posting its biggest monthly gain going back to April. It bolsters the case for a slower pace of rate cuts following last month's outsized reduction. Core PCE, it strips out food and energy items. It increased 0.3% in September. That was in line with estimates, and 2.7% from a year earlier. Overall inflation was 2.1%, the lowest going all the way back to early 2021. And it's just above that 2% goal that the Fed has. Molly Smith is Bloomberg News economics editor. She joins us here in the Bloomberg Businessweek studio. Holistically, taken all together, pretty good print when it comes to the data that we got today.
Yeah, I think it confirms a lot of what we've already known to be true, that the path to disinflation is going to be a bit bumpy, and that's what you saw from the monthly print today. But when you look at the annual figures, you still see them trending downward. And as you noted, that overall PCE print coming in at 2.1%. There were some economists who had predicted it would have hit 2% today. So we're really right there in line with where the Fed wants to be.
What are some areas that aren't coming down?
Services has been really the difficult spot
it's
of
still
inflation.
Sticky.
That, yeah, I mean, it's, we did see a bit on the good side too, but it really has been more so services, and that's where the bulk of spending happens in our economy as well. Housing, of course, is always going to be the big driver there. But yeah, I mean, but the thing is that you hear Americans obviously are very distressed by high inflation and high prices, and you would think that at some point that's got to be weighing on spending, but it hasn't happened yet. We've been calling for consumer spending to slow down for a while, but as long as you still see wages and salaries growing like they did in September, it's hard to see how that spending is just going to collapse.
Yeah, I wanted to ask you about kind of consumer sentiment, especially ahead of the election. It does feel like a really big issue is inflation. Do the numbers that we got today, how does that kind of match up with what your reporting is showing you about how people really feel about this economy?
I think, the way that the regular people think about the economy and the way that we report it here are two very different things. If you ask anyone what they think about the economy, I think views are largely pretty negative, and they will just say that everything's more expensive compared to how it used to be, that it's really hard to find a job if you're out of one right now. But then you look at the macro data, and yes, inflation is easing. And of course, we understand, though, that inflation's a rate of change. It's not talking about absolute prices. So yes, prices are rising more slowly, but they are still rising. So both can be true at the same time. And unemployment is still really low. A lot of job indicators are still pretty solid. Granted, not nearly as, crazy robust as they were in 21 and 22, but that's also was a really unsustainable labor market. And we're at one now that's more normal.
We'll find out details tomorrow how normal it is, because last month came in much hotter than expected at 254,000 jobs added.
Big number.
It was a big number. The estimate for tomorrow is 105,000. Is there a whisper number out there that's different that you know
honestly,
about?
I don't, but I will tell you that the estimates on this are crazy.
They're all over the place?
We've got Bloomberg Economics here is calling for a decline of 10,000 payrolls.
Okay.
So that'd be the first drop since 2020. And then on the high end, you've got a gain of 180,000. So that spread right there is already the biggest in estimates in about a year.
And obviously everybody's taking into account the same information, but some analysts are really concerned about temporary displacement due to natural disasters, no?
Yeah, that's where the payrolls number is going to be really hard to look through tomorrow, and I'm hoping that we get some good clarity from the BLS and not just saying there was, quote, no discernible effect from either Hurricanes Helene and Milton. I always conflate the two letters there. But yeah, those ones were, right around when the BLS tabulates the jobs report. So it's going to be important to look at both surveys tomorrow, because the one that comprises the payroll survey, if you didn't work any time at all in that week, maybe because of weather, for whatever reason, maybe you were on strike, that survey would say you were not employed. You effectively did not have a job. But the household survey would still count that person as employed. So that's a really big difference there. And the household survey will also count people who weren't at work due to bad weather. So that's where we're kind of leaning a little bit more on this survey for tomorrow, even though it is the more volatile of the two.
What does this mean for the Fed, Molly?
Oh, wouldn't we all love to know? I mean, I think that, when you have a report like this that could be with as many caveats as we might be thinking, that I would think that, the Fed is just going to take what their understanding of the labor market already is going into, the meeting next week. And we have, right now, it seems to be a job market that is still strong by many measures, but of course has cooled in recent months. And I think it's one that they still would say is not a source of inflationary pressure, that wage growth has cooled and that job openings have come down substantially, but it also doesn't look like we're at risk of unemployment severely rising.
Is it just me, or are other people putting more weight on these numbers as we get closer and closer to Election Day, given that so many surveys show that the economy is the most important issue for voters?
I mean, I think the way voters think about the economy, again, it's different than what we're talking about in the data. I don't think that the jobs report tomorrow is going to decide how somebody votes. And granted, a lot of people already have voted. So I think what they're more thinking about is like their own personal finances, their own, right now, do they have a job? Can they pay their bills? And does the jobs report tomorrow change that for something that happened in October? I'm not sure.
I mean, I think if we get a negative print tomorrow, then the Trump campaign
they will jump all over it.
All over that.
Of course, if the unemployment rate goes up, sure. I mean, I know sometimes I think about this more practically as someone who's just a quasi-economist rather than what actually transcends over into mainstream media and what voters are thinking about. So yeah, I mean, for sure it's going to be a talking point from either campaign, either way.
All right, Molly Smith, Bloomberg News economics editor here in our Bloomberg Businessweek studio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Stocks under pressure today. The NASDAQ composite down 2.7%, while the S&P 500 down about 1.6%. If we look at how things are looking for the month, well, stocks wiping out their October gains. Microsoft and Meta platforms weighing heavily on the trade after disappointing outlooks. Apple, Amazon are on deck for later today. We hear from the Fed next week. And then, there's the election happening as well. So a lot for an investor to be thinking about. Let's see what Jeff Krumpelman is thinking about. He's chief investment strategist and head of equities at Mariner Wealth Advisors. They've got about $115 billion in assets under management. He joins us here in the Bloomberg Businessweek studio. Did I miss anything in terms of big things that you're focused on? The Fed, the election, mega cap tech earnings. What else is on your mind?
Well, I think it's not just what's on our mind, but what are people going to read in the headlines, that this is a game of psychology, right? And it can push people's kind of moods around a little bit on a temporary basis. So the only thing I would add to that I've seen more lately is there seems to be concern over this uplift in yields. And you've seen the 10-year Treasury go from 360 or so, which was, I think, abnormally low. I think the bond market got a little ahead of itself, and now we're back to 420, and I think people are extrapolating that out to what does that mean about the deficit and that kind of stuff.
Why have we seen stocks not move as a result of the yields moving?
Well, it depends on why yields are going up. And if we had a wild card risk that was out there while everybody else is talking about election and geopolitical and speculation about the Fed and the items that you mentioned, we're really focused on that rise in yields. And back in October 23, we had a moment where they went from 4 to 5, and 5 is kind of a threshold that you don't want to cross in a surge. I think they're going up because the economic data has actually been very good in October. We've had some positive surprises across the board, whether you're talking about service activity in the PMI, if you're talking about retail sales. We did a GDP report coming in at 2.8% with contributions from consumer, business, and government, all three. Labor productivity is on the rise, labor costs are down, and net, while everything's not perfect, it never is. It's better than expected, and that tends to keep stocks holding in even though you have this fear. So if yields are going up because things are stronger, that's way better than if you have yields going up because people are scared half to death about reaccelerating inflation and a deficit that's just out of control. And I don't think that's what's going on.
So does that mean then if we have a Fed meeting next week and we don't get a cut, or we see traders really pricing back how many cuts we're going to get over the next few months, stocks will be just totally fine with that?
No, I won't say that. Whenever we do our forecasts, we're looking out 12, 15 months. And like I said, this is a game of facts and psychology. And there are disconnects between those two from time to time. So if people want to freak out, I think there's valid reasons for the Fed going slow. I mean, if we're heading in a recession, you got to act. But what's so bad about 2.8% growth and inflation that is back to 2 to 2.5% level targets? I don't care what they do. They said at the beginning of the year, we got to cut 6 to 7. This is what I heard. Jeff, if the Fed doesn't cut 6 or 7 times, we're going to have a meltdown. And now you can kind of say, well, how many times did they cut? Oh,
Where's
yeah,
the meltdown?
1.
Yeah.
Where's meltdown? That was at 4,700. Now we're 5,800. So, I take it easy,
Okay.
Relax.
Speaking of people freaking out.
Yeah.
Kava. Okay.
Yeah.
People freak out about Kava. This is a stock that's up 210% so far this year.
Yeah.
When it comes to consumer discretionary, it's one of your picks.
Yeah.
There's still room to run here?
You know what?
Their valuation, people say there's some analysts out there who say this valuation is a little bonkers.
So I was here a couple months ago and the stock was at 80. It's at 133. So I'll take that side of the trade all day.
You're not done with it though.
I'm not done with it. I think it has higher. And here's what's not appreciated. They have 13% same-store sales growth. Let me repeat that. The economy's growing, 2.8%. They're growing 13% same-store sales. They're opening new units at a pace of 15% annually. Their margins are going up because they are operating efficiently. They're introducing digital. They're introducing stake and all these things, and they're going to be able to cut back on their marketing spend. I love stocks that have great catalysts, and I think there's a long runway here that's unappreciated, and they don't have a lot of competition in Mediterranean. They've kind of got the category.
Are you a big Kava person?
I feel like I almost can't even comment here because I'm a customer.
You're just
of Kava.
It's like you have to
we appreciate
that.
Yeah, but
Okay.
I personally think it tastes really good. There's no location of the office though. What about tech? What kind of tech stocks do you like? Because obviously big tech today is selling off quite a bit.
Yeah, we have 6 different strategies ranging from conservative to aggressive. And so we have some purely growth strategies that are benched the Russell 1000 growth. And what I love about that particular strategy that we run, and I don't want to talk too much about it, it's just simply that we believe growth still has a place. The day's not over, but the Mega 7, the Magnificent 7, or 8, whatever you want to call it, they're getting a little tired. Their fundamentals are fine, but they've made a big move. So we, as the market has broadened out, we own them, but we're underweight and have been underweight. And we've been able to do really well because there's a lot in tech. And I give you some of the picks today, like Oracle, like Synopsys. Oracle is AI, at a reasonable price. Maybe that's a new, stock strategy that we'll, develop. But I think that AI is not going away. And cloud's not going away. So therefore, you need to be there, and there's a lot of companies that can benefit from that. By the same token, we just bought PNC a couple weeks ago, and the younger guys on the team are looking at me like, what are you talking about? A regional bank? Mm-hmm. You got to be kidding me.
And what do you say to them?
I say, well, let's see. You're going to be able to unleash some reserves as the credit markets are holding up pretty well. You've got a re-steepening in the yield curve. Let's see what banks do. Oh, yeah, they borrow short and they lend long. And so you get that steepening, and that's where you make your margin. And they're growing in the Sun Belt, and loan growth is solid. They're cheap. So this is a good day for, some good old dinosaur-like, thinking. And you balance the two. I like cloud, but I also like, some good value stories.
Very briefly, we only have less than a minute left.
Yeah, sure.
The election on Tuesday.
Yeah.
Short-term risk around election day?
Well, again,
around the outcome?
I would go right back to psychology, and our advice has been pretty consistent. And it's boring. It doesn't make headlines. It is simply so many people want to sound smart. And they come out and they tell you, we've studied all the policy differences. and this person is going to do this, and this person's going to do that. And so as a result, this is what you need to do. That is a fool's errand. Don't do it. You got plenty of time. What people campaign on is seldom what they propose. What they propose seldom gets passed. And you can't, even if you're perfect on those two factors, you don't know how investors are going to react. So
Jeff Krumpelman, good to see you. Thanks for swinging by our studio. Normally in Cincinnati, Jeff's here in our Bloomberg Businessweek studio. Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, the CDC has now linked 90 cases of E. coli to McDonald's since the first case was discovered more than a week ago. And in Iowa, health officials are investigating a suspected case of Lassa fever after a resident died on Monday. Safe to say, public health is everywhere in our lives, and it's crucial to keeping us safe. It's also the subject of the new documentary, The Invisible Shield. It's a 4-part series. It reveals a little-known truth. The series is made possible by Bloomberg Philanthropies and Radical Media, and the finale airs on Bloomberg Television tonight at 6 p.m. Wall Street time. We should note Bloomberg Philanthropies is the philanthropic arm of Bloomberg LP, the parent company of Bloomberg Radio. We got with us Dr. Amy Acton. She's former director of the Ohio Department of Health. She was the first woman physician to ever hold that position. She participated in the Invisible Shield. She joins us from Columbus, Ohio. Doctor, good to have you with us this afternoon. I think with the pandemic in 2020 and the aftermath, people started to see public health differently. But I think for a lot of us, it's kind of faded into the background. The pandemic, there's so much more to public health than just monitoring potential pandemics.
There really is. You know, one of the things people don't realize is that we gained 30 years life expectancy in the last century. When my grandfather was born in 1900, on average, you were expected to live to about 48 years of age. Some of us would do better, some worse. You were also expected to lose at least 1 out of 3 of your children sometime during their childhood. That was the way of life for almost all of our history. But we gained 30 years, and only 5 of those years were due to everything I learned in med school as a doctor, the stuff we need in the one case. But 25 years came from things that we can only solve collectively. It began with clean water, safe food, child labor laws, to everything we think of today, traffic safety laws. You know, it goes on, but that is such an important thing. We gained, you know, we live on average, my grandfather made it to 84. But we know for the first time we started going backwards. Even before COVID hit, our country is living on average 5 years less than most other advanced countries.
Is that because of the opioid crisis? Is it because of drug overdoses, or is it because of a multitude of things?
It's a multitude of things. I was obviously trained in healthcare originally, but we put about $3.6 trillion into healthcare, but less than 3% of that amount actually goes to preventing the expensive bad things. That is one thing we do a little differently. Before even COVID hit, you know, that trend had started backwards. Actually saw 3 years lost in the years right before COVID hit, and obviously that set us back more. But it was due to things that are often chronic illnesses, diabetes, heart disease, but also intentional and unintentional injuries. We have at a higher rate than our peer countries.
What's the connection between public health and social media and information? It seems like nowadays there's so much information online about how to live a healthy life, and maybe not all of it is accurate.
Our wanting to live a quality of life, I think of blue zones, how we all sort of now aspire to live to 100. That is something that is actually not all a bad thing that is happening. But in terms of the information, you know, it's really important. This documentary takes you through all the way back to the 1400s, the Black Plague, and takes us up through the modern era of communication. One of the things that I think about in communication is our Surgeon General, who did an advisory that the epidemic underlying so much of what we're experiencing here, including the unmooring that is going on, is due to loneliness and isolation. And if you think about it, in some ways, we're more hyper-connected as a world and a community. And One Health means that viruses also interconnect us in a whole community instantly. But we're also feeling more disconnected. And that perhaps is why we're seeing so many of these diseases of a despair. Other countries are actually creating czars. They have 20 years of data that shows, and I really recommend people check out the Surgeon General's advisory on human connection and loneliness, because it talks about ways that we as individuals and relationships can be more connected.
Dr. Acton, got to leave it there. Thanks so much for joining us. Dr. Amy Acton, former director of the Ohio Department of Health. She was the first woman physician to ever hold that position. Once again, The Invisible Shield by Bloomberg Philanthropies and Radical Media, the finale airing tonight on Bloomberg Television at 6 p.m. Wall Street time.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Investors looking ahead to the all-important non-farm payrolls report tomorrow morning. It's the last big data point policymakers will watch before their meeting next week. Also a huge data point before the election on Tuesday. We got with us Jane Oates, Senior Policy Advisor at WorkingNation. It's a media company that focuses on the future of work. Jane, also a former Assistant Secretary of Employment and Training in the Obama administration. She joins us from New Orleans. Jane, good to have you with us. Expectations, as we heard from Molly Smith a little earlier in our program, really range from, in fact, a negative print of 10,000 jobs lost to up to 180,000 jobs added. The median, according to the survey of economists from Bloomberg, 105,000. What are you watching?
I'm really more optimistic. I'm 150 to 200,000, especially after the strong ADP number this week. Adding 233,000. That's the highest since July of 23 in the private sector job count. So I'm pretty optimistic.
What sectors specifically are you expecting to see the most robust gains in?
So, we've gotten spoiled. We all think healthcare. So I think that will continue to get us where we want to be. I mean, the most disappointing one, I think, will be manufacturing, because I think we're really starting to see the impact in the supply chain of a 7-week strike at Boeing.
Talk a little bit about that.
Oh, it's hard for me. I mean, you're not on the inside. You want the best for those workers. You want them to get their old pension plan back. But boy, the smaller manufacturing suppliers in that chain, I think, are really starting to hurt. And you know what, Tim? This is not just a Pacific Northwest issue. Those suppliers are probably all over the country, definitely into the Midwest. I don't know how much more they can take. You know what I mean? Especially the small guys. You think the people that make things like screws, you know what I mean, and nails. That's a big client, and 7 weeks with no new business is tough.
I know you said that you are maybe more optimistic than what the consensus is expecting just for tomorrow. But, what about just zooming out here? We have seen the unemployment rate ticking to, around historically low levels. What is your kind of overall gauge of just the exact strength here of the labor market in America right now?
Look, the consumer is keeping this economy humming. They keep spending, right? So you see, moderate to really kind of optimistic gains in leisure and hospitality every month. That's a good sign. People are traveling, they're eating out, they're buying things. That's what's powering this economy. And especially when you look at the wage gains so far, we're looking at a 4% wage gain year to year. And with inflation going down, there's no indication that people are going to stop spending.
How do you kind of square the wage gains and also inflation? Because, of course, we got data today that was showing that the Fed's preferred gauge of inflation is ticking a little bit hotter than economists had expected.
Yeah, I mean, I think we still have terrible prices from pre-COVID, right, in regular everyday grocery items. You know, people are paying much more now than they were before COVID. And gas was horrible. It's starting to come down, but it's still more than people would like to pay. So I think those along with other big ticket items like housing and, you know, like things like even health insurance. I mean, all these things are going up. People are having a hard time, but it's amazing to me. They keep spending. And, you know, that's just great for the economy.
To you about watch what consumers do, not what they say. That said, how that manifests in the election on Tuesday, because you served in the Obama administration. You understand the connection between voters, politics, and of course, what's happening with the economy, Jane. We see time and time again, the economy is the most important factor to many voters out there. We also at the same time see, according to a lot of research, Gallup yesterday, I cited this yesterday on the show, a Gallup poll from earlier this month says that the majority of Americans don't necessarily feel like the economy is on the right track. How do you balance that with what we're seeing in the economy?
Yeah, I think it's really hard, Tim. You get right to the heart of it. I mean, God forbid, let's never get back to where it was when I was in the Obama administration, you know, during the Great Recession. But it's really hard because people, everyday people, real people who aren't policy nerds and aren't, you know, nerds like you guys listening to this every day, they judge the economy by what things cost. And as I said, things still cost more than they're comfortable with. But I do think, you know, people, you look at that jobs number from last month, you look at the JOLTS number from this week, still 7.4 million open jobs. You know, a lot of people still unemployed. We're not done that job. But that's the kind of stuff that we're looking at big picture. I think getting people to understand that it's a mixture of what you're feeling at your kitchen table and what we're seeing. Because those same people at their kitchen table, if they're in a 401k, they made money on the stock market in the last year. You know, they've been doing really well. It's not just people that we think of as investors. So I think we have to get people to understand it's a bigger picture than just the cost of eggs and gas.
I'm wondering how, if you're a politician running for office, what do you say to get your voters to kind of understand that message that you just unpacked?
You know, I think it's so hard because you know that most people get their news in a flash, you know, in 15, 30-second bites. And it's really hard to get into the weeds there. I think this is the time, if you're running for public office, that you have to do things like town halls so you can dig deeply into these issues. You can't do it in commercials. You know, you can't do it just in sound bites. It has to be really sitting with people, not only telling them the facts, but listening and trying to understand what are the costs that maybe we could control a little bit. You know, what are some things that local communities could do, whether it's, you know, in Northern Virginia, they have a free bus route so people don't have to pay to get to work. That's a really interesting thing. So I think we have to listen to and look at what communities are doing to solve this problem and really to get at the things that are causing people to really struggle in what should be a really good, strong economy.
So Jane, it raises the question about the messaging that we've heard from Vice President Harris, because she is the incumbent. The Democrats are the incumbent party. You served in the Obama administration in the Labor Department. How is her messaging in your view? Has her messaging in your view been good on the economy? Has it been, where could it be improved? How would you grade it?
Well, you know, WorkingNation concentrates on solutions. So I'm going to be on the positive side here. I think talking about things like childcare really resonates, not only with the parents of children, but with the grandparents, because a lot of times those grandparents are being called into active duty when their daughter or son can't get, you know, quality childcare. So I think concentrating on healthcare costs, concentrating on childcare costs, I think that's really important. You know, I think the idea about trying to control costs, look, we're a free country. We're a capitalistic society, and thank God for that. We want businesses to stay strong. So I think when it gets into this like cost control and price gouging and things like that, it's a little unclear to me what could actually be done, but there are clear things that can be done in childcare. We could make permanent the childcare tax credit. There are clear things that can be done when we talk about health care. We could make sure that the state systems in the Affordable Care Act are providing the most affordable options for every family to make sure they can get it. I mean, so I think sometimes the message is too large, but overall, I think the Vice President has been really clear on those two issues that I think from my conversations and my colleagues at WorkingNation, as we talk to people, really child care is really a major issue. And, so is some of this stuff about making sure we're able to control the prices that we can control. I mean, I don't know what we can release more oil reserves to put down gas.
Hey, we only have 30 seconds left, but on the child care thing, one thing that just blows my mind is that dependent care FSA has not changed since 1986. The limit,
exactly right.
5,000 per house. What is going on here? We only have 30 seconds left. What is going on here?
Tim, it's crazy. Like, let's light a fire under Congress and get them to activate, because the same thing, employers are doing so much training for their incumbent workers. That 5250 was in the same set of bills in 1986. 5250 bought you a college degree, in 1986.
Yeah.
It buys you barely a semester right now.
Oh, for the dependent care FSA, it buys you a couple months of daycare. It's a little wild.
Yeah, that is really not enough money.
It's not enough. Hey, Jane, thanks so much for joining us. Always appreciate you coming on the program. Jane Oates, Senior Policy Advisor over at WorkingNation. It's a media company. It focuses on the future of work. She's also former Assistant Secretary of Employment and Training in the Obama administration. As I mentioned, that payrolls report coming tomorrow. 105,000 is what economists surveyed by Bloomberg expect. Last month, it was 254,000.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Ian Rogers has been at the forefront of the transition from analog to digital, particularly when it comes to music, pretty much his entire career. He was the founding webmaster of BeastieBoys.com. He was at the company behind Winamp. You guys remember Winamp if you're over 40 or 40, like me. That was how you listen to music on your computer for the first time. Then he was CEO of Beats Music about a year and a half before it was sold to Apple for $3 billion. Then chief digital officer over at LVMH, the parent company of Louis Vuitton, Sephora, Hennessy, and more. He's now chief experience officer over at Ledger. It's the Paris-based digital asset security company. He joins us here in the Bloomberg Interactive Brokers studio. Welcome back.
Thank you. Happy Halloween.
Happy Halloween. A little spooky in today's trade. Yeah. I want you to give us an update on Ledger, because last time you were here, we spent a lot of time talking about big picture, where we are when it comes to Web 1, Web 2, Web 3. Where are we in Web 3, and what are you doing at Ledger to harness that?
That's a great question, because I think it's one of these things where, like the dot-com boom and then bust, and then...
So that's Web 1.
That's Web 1 and slow growth. I think we spent, 21 and 22 teaching people about the promise of digital ownership. And, then we had FTX and the fallout that came after it, and you end up with that sort of trough of disillusionment. But there is a real invention behind that. This, invention of digital scarcity will be a part of our lives. We've got, huge businesses that are built on effectively digital renting, and we have a new primitive, which is digital ownership, and that leads to Bitcoin and a ton of other things. But just like with the dot-com boom, there was a lot of promise and idea, and then a lot of it had to be built, and the whole thing didn't kind of tip over into the mainstream until 2010, 2012, and onward. And that's really what we're doing is we're building that. We're building on that promise. Now, today is Bitcoin's 16th anniversary, the 16-year anniversary of the Bitcoin white paper, which is, I think kind of why this is Bitcoin's year. It's been around long enough. It's been attacked and, frontwards, backwards, sideways long enough. And people go, oh, wait, an uninflatable, scarce digital good has a reason for existence. And so I think that's kind of where we are. For us, we just keep continuing to build around that. There's crypto, and then there's more, because really we are a digital security company, and we secure not only digital assets, but also your logins. And, as you kind of point to that Web 1, Web 2, Web 3, Web 1 was, all of your data behind a username and a password. Yeah. Web 2 is log in with Google, log in with Facebook. We've all lived in that world for 15 or so years now. And really, where we are going to is a world where the user has control and can choose who I share my data with. We've all kind of seen the perils of our data just kind of being consumed by anybody who wants it. And, now we have a lot of backtracking from
So
that.
that's removing the data from the cloud and storing our data on physical devices that we carry with us at all times?
Well, I think it's a question of what data are we talking about and how do you want it? I mean, if it's healthcare data, then, we care a lot about, where it's stored. If it's, did I like an Instagram post? Maybe we're less concerned about the publicness of that little heart, right? And there's a lot in between. But what we have is like a lack of user control, first of all. And I don't think any of us are really comfortable with that. We all know enough about it, kind of post Cambridge Analytica, et cetera, where we first thought about like, I guess maybe it does matter where all this personal data is. But, it's even just inconvenient. Think about agentic AI applications, right? Like let's say you want to just ask an AI agent to book a flight to Miami for you. How is it going to do that, right? Does it have access to your, does the agent have loaded into it your payment information, your Delta login, or, whatever it is? Like, no, ultimately you, the user, should have that information, and it should ask you, may I have this information to do this on your behalf? And then you say yes, or no, depending on what you as the user prefer. So I think that, it's not something that I think the average person spends a lot of time thinking about, but I think it is something that the average person can understand when you have the conversation.
That example that you just brought up about using AI to maybe book a flight for you, in that kind of instance, it seems like what's so important is not only control, but also identity. How is your company and how are you looking at the market right now and how it's able to kind of balance the growth in AI, but also verifying who's human, who's themselves, and then who is the machine?
Yeah, I think you have, it's what we've been doing in crypto is verifying that you have made a transaction, right? Mm-hmm. What we are going to need to do as humans later is, one, prove we're human. Think about it. If you could just, prove that you are or are not human.
Are we human or are we dancer?
Yeah, exactly. I think if we have the ability to prove that we are human, then I'm a unique human. I am this unique human. That's kind of what we do with our passports, right? I think that we will need that. I mean, we will need in the future to know that it is actually me that's speaking into this microphone and it wasn't altered, somewhere in the path before it got to the listener, right? We can see already that, that these will be things that you will need to know. And we do have the technology to do it. I think it's exactly where we are. We can see that it will be necessary. We have the technology to do it, but we don't have the systems at any scale. It'll take, 10 to 20 years to build that.
You need buy-in from companies on the other side to do this. And I can share an example from today. There's somebody like spoofing me on Twitter. I went to report it. And in order to do that now on X, since Elon bought it, it's very difficult. And I had to solve this like 6-part puzzle to prove that I was a human and that I wasn't a bot. The whole system crashed actually at the end and I wasn't able to ultimately report it. But to me, doing that, there has to be a better way. It's such a great example because it's such an obvious example. And there are people that are out there right now pretending to be Ledger on Twitter. You'll see them or on X. I'm sorry. And that has real value. No, I don't have real value.
People lose their life savings because someone is masquerading and saying they are someone that they aren't. So it is a very real problem. It's not just an annoying problem. It's a problem that harms people. It would be possible for these platforms to say, hey, the way that you identify yourself, you need to, first of all, use something like Ledger, which, very difficult for a bot to do that at scale.
For people who aren't familiar with it, and there are many of these devices out there in the wild, but they're by no means ubiquitous. You guys have raised more than $500 million. Give people an idea what the devices are that you
Sure.
have.
So I brought one of the new Ledger devices with me. This is a Ledger Flex. What these are is they are stewards of your private key. So when you're doing crypto or cryptography generally, such as a login, your private key is the key to saying you are who you say you are. So these devices have in them the same secure chip that is in your credit card or in your passport, but they protect your secrets. And so they are able to allow you to prove that you are who you say you are. So in the case of crypto, that is, I am the owner of that wallet that contains that value, and I approve that transaction. That's what they do in the case of crypto, but also, in the case of simply being my login to Google. If you use a 2FA, two-factor authentication device or a passkey device, that's your way of saying, I'm using a very strong way of proving to you that I am the owner of this account, because I can cryptographically sign and prove to you that I am the owner of this account. So that's what they do. So if you then apply that to the problem that you had, it would be, X could say, look, first of all, we need some proof that you're really a unique human before you create a new account, right? Or maybe you're not a unique human. Maybe you're creating your fourth profile on X, but I would like to know that all four of these profiles are tied to the same unique human. That's a decision that they could make. It's why, it's a difference between a service like Telegram and a service like Signal. Signal says anybody can sign up with a username. Telegram says anyone can sign up with a username. And Signal says, no, you must at least have a unique phone number, right? And these are ways of just kind of preventing that fraud and spam. But there are better ways of preventing that. If you look at what Sam Altman is doing with World, formerly known as WorldCoin,
the eye scanning thing, right?
This is there are people have mixed feelings about it, but this is primarily the problem he's trying to solve. Can you prove that you are a unique human? There are very real if a site like X or an application like X said, we want you to prove that you are a human and a unique human before you create an account. Obviously, we could get rid of a lot of that fraud and potentially like a lot of that that at scale fraud. So I think these things are coming. We're living. If you think about it, we're at the end of a cycle, right? This cycle started around, you could say 1998, but I would argue really more like 2008 is where this kind of cycle really started. And now these applications exist at scale. We have mobile phones at scale, and we have these problems at scale. So now we'll enter into a new cycle that will leverage this new tool, digital scarcity, proof. It's really proof more than anything else. It's and you can use that proof in a number of ways. To solve the problem that you just described.
Just quickly, who is Ledger's intended audience? Is it people who work within tech, or is it, I don't know, senior citizens who really need that digital security because they're maybe more susceptible to getting hacked?
Just like if you would ask, who's Google's audience, the answer is everybody that uses the internet. Who is Ledger's audience? It's everyone who has digital value. So that's a relatively small number of early adopters today. They do run the gamut in terms of demographic. I mean, you have young people, and really there is definitely a generational divide. I was at a wedding recently, and everyone my age said, we don't know what Ian does. He's a geek, and he's always been a geek. And the people who were 27 years old went, oh my God, you work at Ledger? Dude, he works at Ledger. So I can feel that generational divide. But we do have people of all ages, because people of all ages have found interest in digital value. Increasingly, we mentioned that security key application, which has logins. Yeah. Well, that takes us from kind of the hundreds of millions of people who own digital value to the billions of people who have a login problem.
Ian, always good to see you. Thanks for stopping by.
Thank you for having me.
Every time you come to New York, you got to swing by the studio. Ian Rogers, Chief Experience Officer over at Ledger, the Paris-based digital asset security company.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, it's time now for the Drive to the Close with Brooke May.
I can't believe it's that time.
I know. I feel like the show has gone by
interrupted you.
really quickly.
Just I'm such an interrupter.
Well, anyway, Brooke May is here with us on Zoom, managing partner at Evans May Wealth. They have about $1.3 billion in AUM. again on Zoom from Carmel, Indiana.
Brooke, welcome. How are you?
I'm well. How are you? Happy Halloween.
We're doing pretty well. One thing that Emily and I have been a little obsessed with on this Halloween, happy Halloween, is the sell-off that we're seeing in mega cap tech today, and sort of wondering, okay, well, yeah, the rally, it's pretty big so far this year, and it's powered the major indices to record highs. Is this a sign that it's gotten a little ahead of itself?
I don't necessarily think so. I think we're about where we need to be. Right now, this is reminiscent of the second quarter earnings announcements. Companies have been priced to, earnings expectations have been priced to perfection. These companies need to beat on earnings, on revenue, and give stellar guidance. And really what we're seeing is earnings aren't bad, but guidance isn't necessarily what investors want to see. So these companies are selling off and they're taking the market with us. That said, we feel like big tech really continues to be leadership. However, not all big tech is created equally. When we look at these names, we want to see strong earnings growth relative to the multiple that these stocks are trading at. And some are stretched and others seem pretty fairly valued for what we expect in the quarters to come in the way of earnings.
When you look at the market right now, what is really driving these declines? Because we've now erased the gain that we saw in the S&P 500 for October, and it seems like there's a lot of near-term volatility. We have the election, we have payrolls tomorrow, we have these tech earnings, but really what should investors be focused on? We have the Fed next week. I think I forgot about that one at first. What's really driving this market, Brooke?
Really, it's the fact that we've gone up. We've gone up so much so quickly. And at this point in time, what takes us higher? When we look at earnings going into 2025, we think earnings will be up about 15%. That takes us to about $275 in earnings on the S&P 500. If you apply a 21 multiple to that, you get $57.75, which is where we're trading today. So you can expect some give and take based on headlines whenever you're at this point in the market. All that said, we wouldn't be surprised if we hit 6,000 before year end. That's the trajectory we're on, and we see these pullbacks as buying opportunities.
So when you're taking advantage of these buying opportunities, what exactly, if you can't comment single stocks, that's okay, but are you one of those traders that's buying the Mag 7, the trade that's worked for a lot of this year, or do you kind of support the narrative that it's more about a broadening of the stock market rally, and maybe you go for something like equal weighted stocks?
We continue to like big tech. We don't like all of the Mag 7 though. Some of the companies in the Mag 7, Tesla for example, seem really expensive. Their earnings growth projections aren't in line really with where they're trading from a PE ratio standpoint. So we like big tech, but we have to be selective. There is a broadening though, and so we think that there are other areas of the market that you can purchase. When we look at 2024, going into 2024, big tech earnings growth was expected to be 28%, whereas the other 493 names, earnings growth was only expected to be 7%. Now going into 2025, we think big tech earnings will be up about 17%, and the other 493 names up 13%. So there is a broadening of participation, but again, you have to be selective. Companies are sensitive to interest rates, and so we're looking at companies' balance sheets and their free cash flow because we're in the camp that rates are going to continue to be higher for longer.
What's the risk? What's the biggest risk you see out there right now?
The labor market.
Really?
Well, it's really what's held up this economy for the last 2 years. And if we see it continue to soften, that's going to be an issue because if sentiment changes, the economy can change pretty quickly. That's not our base case, though. We do see a softening, but not meaningfully. Unemployment is at 4.1%. We would expect that to be the next read. We really think that the Fed indicated that they think max unemployment could be 4.4%, and we probably won't reach that if the economy stays on the solid footing that we've had here recently.
Brooke, I'm looking at your notes, and you have I'm trying to make this kind of geared towards Halloween. I don't know if it's going to work, but maybe a foreboding forecast. This may be the last chance to buy the 10-year Treasury over 4%. Why do you think so? Where do you see yields going?
Well, we think that the Fed will likely cut rates in November and again in December, but possibly pause after that. A few weeks ago, the market was pricing in, 8 or 9 rate cuts in the next 12 to 18 months. And now we're thinking it might be 4 or 5. So that's going to leave rates prolonged a little longer. However, there's no assurance. And we've seen since the first rate cut, the 10-year Treasury go up about 75 basis points. That's significant. That's a significant move. And for years, I had investors say, if I could just get 4% again, I would lock in fixed income. And now we're really having to persuade them to increase their fixed income allocation. With the market being what we would consider to be fully valued, that's a way for us to get some good returns and do it with a little bit more assurance than in the equity market.
Brooke, given the equity market is by many measures expensive right now in many parts of it, not all of it, mind you, how are you putting new money to work right now when you get it?
Mm-hmm. We're dollar cost averaging into the market. I'm looking at where we are at this point in time and seeing that we are fully valued. There's risk, whenever you're hitting new highs day after day. And so I'm putting money into the market over the next 6 to 12 months.
What are you thinking ahead of the jobs report tomorrow?
We think that it's going to be probably as expected. We wouldn't be surprised if unemployment stays at 4.1% and we add 100,000 jobs, give or take. Really, the estimates, though, are all over the place. Some are indicating a decline and others exuberance in the numbers. So we would expect it to be somewhere in line with consensus, somewhat muted. However, nothing alarming at this point.
What you said the biggest concern is the labor market. What would alarm you? Like, what do you need to see? Because by many measures right now, the labor market is very strong. What would you need to see from tomorrow or from the next few months to indicate that it's not as strong as people think?
If we have a steady climb in the unemployment rate, that's going to be very concerning. If we were to see unemployment come in tomorrow at 4.3% and not adding as many jobs, that's something to take a look at. Clearly we have a softening. A year ago, there were 2 job openings for every unemployed. Now it's closer to parity. I think there's 1.1 job openings for each unemployed. So there was definitely a disconnect in the labor market, and it was almost too strong because that created wage issues. Where we are right now is really the sweet spot. And if we can maintain this level, it's going to, the Fed has orchestrated that soft landing that we all were hoping for.
Brooke, appreciate you joining us. Good to see you again. Happy Halloween. Brooke May, managing partner over at Evans May Wealth, about $1.3 billion in assets under management. She joins us from Indiana.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.